Hi, my name's Diana Britton with wealthmanagement.com. I'm here with Mark Tibergien, CEO of Tibergien, and we're talking about some of the changes in the advisor industry and how advisors can deal with those changes. So, I mean, demographics are changing, Mark. People, advisors are getting older, the age gap's wider. You were talking about how margins are really pressurized right now. Clients are demanding more. What's causing the pressures on margins?
Well, there are a number of things that are impacting advisory firms today, not the least of which is they've been so consumed by the moment where they've had to come through this crisis truly thinking about what's for lunch, not what's down the road. As a result, they haven't been able to think strategically about their business. They haven't been able to organize to achieve better operating efficiency. They haven't been able to go out into the market and grow revenues the way that they should. So the first question that we try to understand when we're looking at an advisory firm as a custodian, when we're attempting to do relationship management with them, is to understand whether they know what the 6 levers of profitability are in their business and whether they're actively managing to those levers. Mm-hmm. So to review, when we look at the 6 levers, we're saying that, that clearly they have to understand pricing, productivity, service mix, client mix, cost control, and revenue volume. Mm. So each of those components by themselves can have a profound impact on the bottom line. Oftentimes people think in terms of the business suffering from price compression, but we tend to phrase it as margin compression because all of those other elements are tending to infect the level of profitability that they need to achieve. Mm. So I would say that the probably are the 3 biggest areas that we're concerned about most today is the fact that most advisory firms have not looked at their workflow and their level of operating efficiency, that costs from an overhead standpoint are running rampant, and third, that there isn't a clear and coherent pricing strategy for many.
Mm. So you say overhead costs are rising. What's causing that?
Overhead costs, when we look at a business, are really related to all the things not touching compensation for the advisors themselves, so it's everything else. So in particular, what we're seeing is that the cost of labor, particularly at the administrative or support level, is increasing. That's been pent up for several years due to the market cataclysm. And as a result, we're now seeing pressures on that, particularly when you have to recruit. There's a cost associated with that. And then benefits, of course, are tied to that. The cost of rent in many markets is starting to increase again. That's big. And of course, the cost of compliance. And it may not be hiring more people, although that certainly could be a factor, but it may be just in the way in which they're addressing all of risk management in their business, from paying for mock audits to having a more robust safety program within their business.
Yeah. And you were saying before that you guys did a survey about 1/3 of advisors said they are raising their fees, correct?
Correct.
How do they raise their fees when returns are lower in this environment? How do they go about talking to clients about that and telling them that?
Well, the advisory firms that have managed to raise their fees are conscious of the fact that they have a good, strong relationship with their clients and that their clients are perceiving a value. Many of them already are using some systematic program for surveying their clients to get feedback on a systematic basis. But the notion that we're finding in the business is that advisory firms that first understand their cost of delivering, second understand what the market is charging, and third can demonstrate their value beyond investment management tend to be able to go to their clients, certainly with new ones, but many with existing clients, and justify a higher fee. We're not talking about wildly increasing fees, but that's one way to do it. The second strategy is really focusing on the low end of their client base to increase the brackets if they're on breakpoints to decide how much one should pay at the lower end. They're trying to look at fees in terms of dollars, not percentage or basis points, and that's a more conscious and deliberate strategy for pricing.
Do you have any more advice about how advisors can go about meeting the challenges out there, getting the margins better?
Yeah, I think that this is an opportunity for advisory firms to to be thinking about, first of all, is their strategy still relevant? Do they know who their optimal client is, and they've built a client service experience to support it? Second, are they structured right to support the strategy? Third, do they have the right people doing the right things? And four, are they actively managing the profitability, as we discussed before? So if they're conscious of those elements, then they can get to a level of success that we would consider to be good.
Okay, great. Well, Mark, thank you so much for calling by. I really appreciate your advice.
Thank you.
And for more information, go to wealthmanagement.com.